Welcome back to Nova Bourse US. Today, we are diving into the hidden geometry of the markets. Have you ever wondered why a stock suddenly stops falling and bounces upward at a very specific price point? It often isn't random. In this episode, we explore Fibonacci retracements, extensions, and the Elliott Wave principle, tools that help us decode the market structure. Whether you are a complete beginner or looking to sharpen your technical analysis, this session will provide you with a structured framework for identifying potential support and resistance zones. We are in the middle of our technical analysis season, and today is all about understanding where price might head next. Let's get started with episode 23. To understand why these tools matter, let's look at the October 13, 2022 market bottom. The S&P 500 touched approximately 3,500, which was its lowest level since the pandemic-era rally began. If you look at the entire advance from March 2020 to January 2022, that low aligned almost precisely with the 50% Fibonacci retracement level. Within just a few weeks of hitting that mark, the index surged more than 600 points toward 4,100. This is exactly what we are going to learn today: how to use these mathematical tools to identify potential turning points before they happen, giving you a structured way to view the market. The history of this methodology is quite fascinating. Consider the legendary call made by Ralph Nelson Elliott on Wednesday, March 13, 1935. At the time, the Dow Jones averages were finishing near their daily lows and bearish sentiment was everywhere. Yet Elliott sent a telegram to Charles J. Collins stating that all averages were making their final bottom. The very next day, March 14, 1935, marked the closing low for the year, signaling the end of a 13-month correction. Elliott had arrived at this conclusion after studying 75 years of market data across every time frame imaginable, from yearly charts down to 30-minute intervals, creating a framework that remains one of the most enduring, if debated, tools in our industry. Long before modern trading platforms, a man named Leonardo of Pisa, known to us as Fibonacci, published a book called Liber Abazi in 1202. He introduced the Hindu-Arabic numeral system to Western Europe, but he also hid a specific sequence within his work: 1, 1, 2, 3, 5, 8, 13, 21, 34, 55, and so on. In this sequence, each number is the sum of the two preceding it. As you continue this progression, the ratio between consecutive numbers converges to approximately 1.618, which is the golden ratio, or phi. Its inverse is 0.618. These two figures form the mathematical foundation for every Fibonacci tool you will see on your trading screen today. When you open a platform like TradingView or Fidelity Active Trader Pro, you will see Fibonacci retracement levels drawn between a significant swing low and a swing high. These horizontal lines serve as your percentage map for potential support or resistance. We focus on 5 levels. 23.6% suggests strong underlying momentum. 38.2% is the first meaningful support in a healthy trend. 50%, while not a true Fibonacci number, is widely used because markets often retrace half of a major move. 61.8% is the golden ratio, often the deepest support before a reversal. Finally, 78.6%, the square root of 0.618, represents an extreme retracement where the trend is in jeopardy. Let's apply this to the S&P 500 bear market of 2022. When the index peaked at 4,796 in January and began its descent, Fibonacci levels provided a clear roadmap. The 38.2% level sat at 3,815, which was the first major support zone tested in May. Below that, the 50% level at 3,505 marked the exact area where the index bottomed in October. Had it fallen to the 61.8% level at 3,195, it would have signaled a potential full trend reversal rather than a simple correction. By watching these levels, traders had a predefined framework for the entire decline. There is a fascinating rule regarding the 50% retracement. Since 1946, there have been 13 bear markets in the S&P 500, and every single one ended only after the index recovered and cleared its 50% Fibonacci retracement level from the bear market low back toward the previous high. In August 2022, with the S&P trading near 4,207, Wall Street was fixated on 4,231, which was the 50% retracement of the decline from 4,796 down to 3,666. Being just 0.5% away from that threshold was a massive psychological signal, illustrating how these tools work through self-fulfilling behavior among institutional traders. While retracements help us measure pullbacks, extension levels project how far price might travel in the direction of the trend once a pullback is complete. The key levels here are 100%, which is a one-to-one measured move, 161.8%, which is the golden ratio extension and a common profit target, and 261.8%, often seen in strong, aggressive markets. If you have an uptrend where Wave 1 spans 100 points and Wave 2 retraces 50 points, you might project Wave 3 to reach the 161.8% extension, which would be approximately 162 points beyond the Wave 2 low. In December 2024, with the S&P 500 trading above 6,000 and hitting its 56th record high of the year, technicians used extensions to find upside targets. By projecting the advance from October 2023 to March 2024 onto the April 2024 correction low, the 161.8% Fibonacci extension produced a target of 6,272.68. Beyond that, a cluster of extensions between 6,808 and 7,020 represented a higher zone target. These projections don't tell us when a price will be reached, only that these levels are probable destinations. The same logic applies in reverse for calculating downside targets during market corrections. The Nasdaq 100 provides another great example. In early June 2026, the index closed above 30,000 for the first time, fueled by gains in companies like Dell Technologies and Micron Technology. With the index up 33% since late March, technicians targeted 32,700, which was the 100% Fibonacci extension of the April to October 2025 uptrend. Meanwhile, the 20-day moving average near 29,400 was flagged as a potential pullback zone. This shows how extensions act as forward-looking reference points, helping you navigate even the most parabolic high-speed trending markets with a sense of where the momentum might eventually face resistance. Consider Tesla in 2013. After breaking out above $43.52, the stock rallied for 26 consecutive weeks, moving from roughly $25.52 to a high of $194.50, a gain of over 660%. When the correction hit, Fibonacci levels provided the roadmap. The 38.2% retracement was at $129.95, the 50% level at $110.01, and the 61.8% level at $90.07. Tesla bottomed at $116.10, right in that support zone. A trader entering around $120 would have been near the perfect low. In mid-2023, Tesla approached $300, where four independent signals converged. First, the 61.8% Fibonacci retracement of the decline from its all-time high to its January 2023 low sat at $299.05. Second, a descending trend line from the all-time high intersected near $300. Third, the 200-day simple moving average hovered near $292. Finally, $300 is a psychological round number. When these tools align, the zone gains massive significance because different groups of market participants, from trend followers to Fibonacci traders, all have a reason to act. It isn't magic. It is simply the convergence of various analytical strategies. Let's return to the man behind the wave theory. Ralph Nelson Elliott was born in 1871 and spent his life as an accountant in Central America and the United States. At age 58, illness forced him into retirement, so he turned to the stock market to keep his mind sharp. Between 1932 and 1934, he analyzed 75 years of market data and discovered that prices do not move randomly, but in recurring wave patterns driven by mass psychology. His book, The Wave Principle, published in 1938, laid the groundwork for a system that is still widely used today, and Elliott Wave International remains a major institution based on his original findings. Elliott's core insight is the 5-3 structure. In a bull market, 5 waves move with the trend, labeled 1, 2, 3, 4, and 5, followed by 3 waves against the trend, labeled A, B, and C. Waves 1, 3, and 5 are motive waves, which further subdivide into smaller 5-wave patterns. Waves 2 and 4 are corrective, subdividing into 3-wave structures. This is fractal, meaning a 5-wave pattern on a daily chart might just be wave 1 of a much larger weekly pattern. Elliott defined 9 degrees of wave size, ranging from the massive grand supercycle that spans decades down to the subminuet, which you can only see on hourly charts. Because Elliott wave analysis is subjective, you will often see analysts disagree on the count. However, there are 3 absolute rules that, if violated, invalidate the entire structure. First, wave 2 can never retrace more than 100% of wave 1. If the price falls below the start of wave 1, your count is wrong. Second, wave 3 can never be the shortest of the 3 impulse waves. If wave 3 is shorter than both wave 1 and wave 5, you must relabel. Third, wave 4 can never overlap with the price territory of wave 1. In a bull market, wave 4 must stay above the top of wave 1. These rules are the guardrails that prevent forced interpretations. Elliott and Fibonacci are inextricably linked. In impulse waves, specific ratios appear consistently. Wave 2 typically retraces 50-61.8, 76.4, or 85.4% of wave 1. Wave 3 is frequently 161.8%, the length of wave 1. Wave 4 usually retraces a shallow 14.6, 23.6, or 38.2% of wave 3. Wave 5 is often equal to the length of wave 1, or 61.8% of the total length of the first 3 waves. In corrections, wave B usually retraces 50 to 78.6% of wave A. These ratios turn wave counting from a visual exercise into a quantifiable framework. Not all corrections look the same. Elliott identified 3 main patterns. First is the zigzag, a sharp 5-3-5 correction where wave C is a powerful move that often reaches 161.8% of wave A. Second is the flat, a sideways 3-3-5 correction where wave B often retraces nearly all of wave A, which can be very frustrating for traders looking for a deeper pullback. Third is the triangle, a 5-wave sideways pattern labeled A, B, C, D, E, where each wave consists of 3 subwaves. Triangles represent a balance between buyers and sellers and usually precede a final, decisive thrust in the direction of the larger trend. Identifying these shapes helps you understand the current market sentiment. We must also discuss psychological levels. Human beings are naturally drawn to round numbers. For stocks below $10, prices cluster around 25-cent increments. Between $10 and $50, whole dollar marks like $25 or $40 act as magnets. Above $50, $5 increments like $150 or $175 become significant. Once a stock is above $100, $10 increments like $400 or $500 act as major barriers. These are not Fibonacci levels. They are human levels. Traders place their stop losses and take profit orders at these round numbers, which is why they become support or resistance. When Apple crossed $100 in 2014, it was a major milestone. The highest probability trades occur at confluence zones where multiple tools point to the same price. Imagine a scenario where a 61.8% Fibonacci retracement aligns with a prior horizontal support level, a 200-day moving average, a descending trend line, and a psychological round number. Each of these tools attracts a different type of trader. So when they all overlap, the price level becomes a major focal point for order flow. We saw this with Tesla near $300 in 2023 and the S&P 500 at $3,500 in 2022. If one tool makes a level interesting, 3 or more tools make it a zone that you absolutely must mark on your chart. Critics often argue that Fibonacci and Elliott Wave lack a scientific foundation. They claim there is no physical law forcing price to stop at 61.8%. They are technically correct. However, these tools work because they are the most widely followed frameworks in technical analysis. When thousands of institutional algorithms and retail traders all watch the same Fibonacci levels, their collective actions create the very reactions they anticipate. The 50% retracement rule for bear markets is not a law of nature. It is a law of crowd psychology. Understanding this distinction is key. These tools aren't crystal balls. They are maps that show you where the crowd is likely to gather. To wrap up, remember three principles. First, Fibonacci levels provide a probability framework, not a guarantee. Use them to watch for reactions, not to blindly execute trades. Second, always respect the three hard rules of Elliott Wave. Beyond those rules, maintain flexibility and humility, as even expert analysts can disagree on the count. Third, confluence trumps everything. A Fibonacci level in isolation is just a line, but a level that aligns with a moving average, a trend line, and a round number is a zone where the market is likely to act. Our goal here is not to predict the future with perfect accuracy, but to prepare for the most likely scenarios and manage our risk accordingly. That concludes our look at the geometry of the markets. By now, you should have a solid understanding of how to use retracements, extensions, and wave patterns to structure your technical analysis. But we are not done yet. In our next session, episode 24, we are going to move beyond these tools to explore the actual language that institutions use among themselves. We will cover higher highs, breaks of structure, order blocks, and the footprint of large players moving significant size across the markets. This is the smart money approach to reading the charts. I will see you in the next episode as we continue our deep dive into advanced market structure.